Welcome to this breakfast session for Wired Sussex members. I'm Anna, Events and Marketing Coordinator here at Wired Sussex. I'd like to thank you all for coming and also thank our sponsors Plus Accounting who have sponsored this series of sessions. Today we're going to be joined by Alex Morrison, Founder and Managing Director of Cogapp, and Sam Garrity, CEO of RocketMill, and they'll be talking all about employee ownership, so I'll let them get started. Over to you.
Thanks very much, Anna. So I'm chairing, and it's actually Sam is going to be talking mostly. I'm going to be interviewing him, and then we'll do that to explain the journey that he's been on, and then we can take questions once we've finished going through that story. I think it's very pertinent what Sam's talking about. I think lots of us are in some part of this journey, thinking about businesses and how to deal with them. And having spoken to Sam over the last week or so, I think the things that they've been doing are both very clever and very innovative, and also very generally applicable. So I think it should be a really interesting session, and I hope it will prompt lots of thoughts and perhaps some action. If we can put questions in the chat, that would be very helpful, and then we can kind of run the session after the presentation. We can run the session from that. So I've got some questions I'm going to ask Sam, and I'm going to get going. Unless there's any other housekeeping or anything else that anybody wants to. All right. In which case, then, so Sam is the founder and CEO of RocketMill. Sam, if you could just start off just telling us a bit about what RocketMill does, to give some context for what we're talking about, that'd be very helpful.
Yeah, no problem. It's all very simple, really. We're a marketing agency. We started life a little over 10 years ago now as a self-funded startup, and it was very much at the beginning designed to help SMEs interact with potential customers online. So I'm talking like Bob the Builder, tiny little clients. And since then, we've grown to a team of over 100 staff in Brighton here, working for some of the UK's most noteworthy brands. And generally, our services can be bucketed up as analytics, strategy, creative, and media.
Cool. So the reason for this session today is about the transition to employee ownership. Can you just tell us a bit about that to get going, and perhaps what prompted it?
Yeah, no problem at all. Our business has grown very quickly for a number of years. So like our compound annual growth rate's about 35% for each of the last 5 years. And this has resulted in a lot of other companies looking to acquire us. We've never put the business up for sale. Sorry, I'm just going to move here because we've got a very efficient office where the lights turn out. That we've had a lot of interest in the business over recent years, and one recent approach was excellent on every level. It's important to say we've never put our company up for sale. These were all unsolicited approaches, but one approach recently really tested our mettle. But the issue we found with it was that just two of us, Ben and I, who founded the agency, would essentially be big winners, and we wanted everybody to win if ever something like that was to happen for our company. So we started to explore the concept of employee ownership. And I should also say, though, and it's really important, that was our context. That was what was happening in our business. But if you look around the marketplace and if you assess what the government set up this scheme for, employee ownership is suitable for many scenarios. So if you look at the major businesses like John Lewis, it's applicable to them. They've done it, executed it very well, and have a celebrated employer brand as a result, and it's a key point of difference for them. You've got SMEs like us, and also it's very applicable to far smaller companies, because the government created employee ownership because they wanted to encourage multi-generational independent companies that share the spoils fairly with their team and perform better as a result. So I think my message to everybody is, don't think that this scheme or this framework only fits a certain type of business or a certain scale of success. It's very applicable for all manner of businesses.
Thanks. So what exactly have you done?
Yeah, the short version of events, I suppose, is that we sold our business to our employees. But that's it in lay terms. There's a lot more to it. So Firstly, we were governed by this feeling that it was the right thing to do. That was a very emotional journey, but we needed to arm ourselves with all of the intellect. So there was a lot of diligence before we jumped in, tons of research. So we used external corporate finance advice, and we engaged a specialist employee ownership consultancy called Baxendales in London. And we made sure that we really, truly, fully understood all of the implications before we eventually decided to take this route. Employee ownership is a HMRC regulated scheme. So when you approach it, you need to be diligent, it needs to be watertight. And in the interests of kind of, I suppose, sharing as much information as I can on the call, I thought it might be helpful if I walk everyone through some of the simple steps that you take in a kind of chronological series of events. So firstly, you need to agree a fair valuation of your company with HMRC. And we used a third party in the interests of doing it as professionally as we could and as fairly as we could. We used a third party to value our business. And then once that valuation was agreed with HMRC, we discounted it for the team. So essentially, we gave the team quite a large stake of equity from the get-go. Now, this valuation sits as a debt on the company and is paid back to the sellers of the company over an acceptable period of time. And that is also agreed with HMRC. For example, we are going to be paid back over a period of around 6 to 8 years in a way that doesn't prevent the business from investing in its own growth and rewarding the existing team. So that's kind of the financial bit. But you also need to put in place the right governance so that HMRC know that your business is really being run for the benefit of its employees. For us, this meant creating an employee ownership trust that sits above our board. Now, the trust owns 51% of all of our shares, all of our equity, and it owns them for and on behalf of all of our employees. Now, the trust, it's important to note, have a light touch role. So they meet in our business once per quarter, and they're really simply there to make sure the business is being run for the benefit of its employees. And although they have a light touch, the trust is incredibly powerful and can remove directors from our board. Now, the board in the business remains pretty much the same and still runs the company on a day-to-day basis, much as they did previously. In terms of our daily behaviour as a business, the culture within our company, I think we're much the same because we've always run a very transparent business. We've always had a philosophy of putting people first. And so I've not seen any big kind of tectonic changes in the cultural behaviour of our staff. But what I would say is that if your business is more of a closed shop, if it's a top-down business where information doesn't cascade across the business freely, then a move to employee ownership will come with, I believe, some significant cultural shifts, which I suppose I could sum up as being, you know, you'll end up being more democratic, you'll end up being more open, and you'll need to be ready for that change.
When we spoke on Tuesday, I think it was, there was the employee ownership, and then there was some other details. Do you want to talk a bit about that?
Do you mean in terms of the EMI and things like that? Yeah. Okay. Yeah, this is important. Some businesses they choreograph it incorrectly. So I'll just walk you through it. So if I tell you about the makeup of the equity in RocketMill, 51% is owned by the trust for and on behalf of the business. That's the minimum you can have because it means that the majority of your shareholdings is owned by the trust for and on behalf of all of your employees. We also have 39% of our shares in an EMI scheme, which is an incentive scheme of share options for our most loyal and most senior staff. And then Ben and I have the remaining 10% between us. Now, the important thing in the choreographing of events is that you do the employee ownership first. Now, by doing that first, obviously you're valuing the business, you're creating a debt on the company, and therefore the value of the company from day one on the employee ownership scheme, the value of the company is suppressed. So when you start doing an EMI scheme, let's imagine it's day one of the employee ownership, and you submit an EMI scheme to HMRC, the value of your company is being suppressed by the debt, and therefore the share options that you will be creating for your team will be the option price, the price that they will pay for them if they ever do action their options and therefore benefit from them in any kind of sale. That value is really low. So you're giving them the biggest possible upside. So I think my advice to anybody is, if they're looking at an EMI scheme at the moment and somewhere in the back of their mind they're thinking about employee ownership too, I would expedite the employee ownership and look at that as a priority, and then do EMI as a second step, not before.
And am I right that the EMI scheme, the options are that they exercise on some kind of what I think the technical term is a liquidity event? So if the business gets acquired, then the options action, or is it something like that, or is they on a time scale, or how does that work?
For everybody, it will be different. So this is where it comes up to you and the advice you take and what's right for your company. In the interest of just transparency and weaponizing you with as much information as possible, our EMI scheme essentially has trenches. So it says that if the company performs in terms of year-on-year revenue growth by X% in a certain year, then your share options increase for this, and then it goes on for the next 3 years. The ability to exercise those options are twofold. One is, yes, if the agency was to, if the trust decided to sell the agency or take investment, that is, as you say, like a liquidity event where potentially those share options will be exercised. The other route that the team do have is that they can offer to sell those options to the trust. Now, the trust will buy those if it's in the interests of the team, which it normally would be to buy its own equity back, but it's not wedded to that. So there isn't a, if you think about it, if you allowed everybody that and you guaranteed that the trust would buy them back, if half, 39% of the equity was to be offered in one day back, you could end up bankrupt. So it's, you've got to be very careful, and my advice would be to stack the terms very neatly in favour so that you have control about when options are exercised within your business.
Cool, thank you. So that's all done. When was it done and how is it going?
We've had it in place for a few months now, so we're finishing pretty much our first quarter within it. I think it's going really well. However, I almost wish I'd watched one of these talks before, because when we launched it, there were a ton of questions rather than like this wild celebration. We'd obviously researched it very thoroughly. We understood it. We'd been on the whole journey, and we'd become incredibly excited as a board about what it meant to the wider business. But when we launched it to the team, it was brand new to them. It was day one of their journey. So I was in this peculiar position where I'm presenting from home to 100 people. I'm super excited, borderline tearful in the journey we'd been on. And it was a complete full storm on day one, because we'd been on the journey. It was a start for the team, and what they had essentially was, rather than this great celebration, they just had tons of questions. So what we did after we'd shaken off the slight disappointment of the reaction was we immediately created the ability for the team to ask anonymous questions on Slido. So this gave us a great insight into what everyone was really truly thinking, and we added that and weaved it into a document that was already in play anyway, which explained everything and addressed all of their questions. Now, since then, we've enjoyed a wonderful reaction, like lots of unprompted personal notes to us about the generosity of the scheme and what it means to individuals. We've had feedback from our head of recruitment that talking to people in the marketplace is easier. We're getting greater response, and of course, in the current climate, depending upon what part of the overall industry you're in, access to talent's really tough. So this has added a great string to our bow in terms of bringing people in. But what I would say, if I was to sum it up, Alex, would be that we're a more aligned business than we've ever been. Brilliant, thank you. We're nearly at the end. I think we've touched on some of this before, but just as we get to the end of your story, are there any learnings in particular that we haven't already touched on that you'd like to just get out there? Yeah, I think do your research. It's a very big commitment, and so invest in third-party help. Don't just come to talks like this and decide it's the right thing for you to do. I think that advice that you should invest in should be across 3 areas at minimum. So one should be corporate finance, so that you've got somebody who specializes in M&A and that type of thing, and understanding different vehicles available to you. I would say tax is a big consideration within all of this. As a founder or large equity holder, this event has an upside for you in terms of tax. There is a 0% capital gains tax applied to this if you go down this route. So it's very beneficial to large equity holders within businesses. And really importantly, I think you need to engage in using an employee ownership specialist such as Baxendale's, who I was referred to by another Brighton business that's similar to us, and I can highly recommend as a first port of call for you. The other part I would say, and we had some of this in place, but I think we could have improved it, is have an engagement plan for the launch and understand that you're ahead of your team in terms of knowledge. So there's not going to be an immediate fanfare. I think because you feel like you're doing something so ethical, so right, you'll be very proud of yourself that you're taking the business down this road. And it can be quite disappointing when you don't get that immediate reaction. So I think being ready for that on the emotional journey you're going to go on will be wise. And then think about how you're going to connect your team to the benefits of it on a regular basis. So the upsides, and the first one is large and sometimes not very tangible, but the upsides for the team include the absolute knowledge that this business is now being run for their benefit. It has corporate governance in place that means that that's the case. They can also receive up to £3,600 tax-free bonus every year, which is pretty considerable depending upon the kind of level of individual in your business. And they are essentially holders of equity in your company. So you need to illustrate to them, I think, what that value is, as well as showing them kind of how that value is changing. So if they are contributing to growth in terms of your earnings, your net profit, obviously you can attach a certain story there. And obviously as the repayments are made there, it's like a mortgage that they're paying off, but it's not coming at any great sacrifice from their side. So there's 2 bricks that are building. There's growth in your EBIT, your net profit, whatever you want to call it, and there's growth in their equity via paying the original shareholders back. And we really try and connect the team to that so that they can see, okay, the average 1% of RocketMill is now worth this, and they can translate that to what it means to them. And then they know every win, you know, every time we're cautious with our resources, every time we assess a new individual to join our business, every time we're on a pitch, there's just a slightly different feel and behaviour and lens that they're looking through.
Fantastic, thank you. I'm just going to pick up a question from the chat. And I'll expand it a little. So the question is, how much did the external support cost overall, just ballpark? But I think also, was it a big distraction for you and your partner while you were doing it? There was a lot of work, presumably, in doing this. So how much did it cost, and how distracting was it to do it?
So costs roughly 25,000. There was a bit more in terms of in our business, because I got, for instance, like 3 different specialists on the line that all do the same thing in a conference call, where they weren't going to win a future opportunity of working with us, but I just wanted truly independent advice, and we kind of put them all on a call. So I think for us, we probably spent another 10 to 15,000. But I think if you went straight to a company like Baxendale's and were prepared to spend £25,000, you'd be in the ballpark of coming out. And by the way, importantly, that included the setup of our EMI scheme. Wow. So you may well just go down the EO route, the employee ownership route, and that fee would probably be a fair bit lower, maybe £5,000 to £10,000 lower. I'm not sure.
And in terms of how distracting it was for you as senior management and owners at the time?
Yeah, the most distracting bit was actually just the tons of approaches we were getting before it. And so having to be polite to all of those, you know, and they're really interested in your company. In the end, what we did is we employed an M&A consultant just to handle all of those conversations so we could deflect them and focus on the business. They are way more distracting than employee ownership. I think I said to you, Alex, earlier when we were just waiting for everybody to join, it feels like we've sold our business without selling it. The culture hasn't changed dramatically. We don't have a third party around our boardroom table. We don't have the pressures of an earn-out or anything like that can sometimes change behaviours within a business, and not always for the better. So I actually think, compared to normal M&A, this was not that distracting at all.
Fantastic, thank you. And here's another question from the chat, a very useful one, I think, which is there a lower limit on size? Do you think, would this be suitable for a small team, say 5 people?
My reading, and again, like, I'm on this call as somebody who's just gone through this, and so I'm going to caveat it. I'm not an expert. I'm just trying to give you the real world version. But when doing the diligence at the beginning, my reading of the government scheme was that they're trying to help businesses create multi-generational companies that remain independent. So let me give you a quick example. Let's imagine a small accountancy firm over in Hove with 5 people. The government are worried that businesses like that, which make up a large part of our economy, when the founder decides that he or she is going to retire, the business is potentially too small to sell. And so it potentially essentially stops when that person decides enough's enough. So I think this is a vehicle for even those companies to transition and keep that business alive, and to find a sustainable way where it's almost like a management buyout, but without, you know, the horrors of deeper M&A and leverage and raising tons of money externally. So I think, yes, it is, in short, it is absolutely applicable for all sizes.
Cool, thank you. Another question, does it affect any personal finance things? Did you have any issues around personal finance, getting mortgage applications?
Oh, so that's very interesting. I'm happy in my house, have been for a long time, so it didn't affect me. But my Ben, who founded the agency with me and is my brother, is 7 years my junior, and him and his wife have a young child, and they were considering looking at another property, a slightly larger property, and I think it does affect them. They don't have an income as such anymore. But that's unique to our deal. Like our deal, we discounted the deal for the team and we dropped our salary. So we wanted to create some real upside for the team so that they had huge equity in it from the get-go. And so, yeah, Ben may have snookered himself slightly for a couple of years there.
Thank you. I'm aware.
Can I just jump in? One thing there. Our scenario is a bit different, I understand, but the other interesting thing for us was, of course, this zero, on a personal level, personal finance, 0% capital gains, which it used to be called entrepreneurs relief. And if you sold your business, you would be charged 10% on, you know, pretty much everything up to about 10 million, I think it was. Now it's 10% up to 1 million and 20% thereafter. That's quite a considerable sum of money, depending upon the transaction you might do if you sold your company. In this scenario, you pay 0%, no tax. So it enables you to, I suppose, sweeten the deal for your team if you're that way inclined. And that's what we did. And that was a personal finance situation created by this vehicle that allowed us to give, again, everybody a win. We got a win, and we kind of passed most of that on to the team. Fantastic.
I'm aware that we've got somebody on the call who's also been on this journey. Richard, at Clear Left, you've been listening to all this. Do you have comparative comments or things that were different for you, or things that you want to add to this conversation?
Yeah, our experience was very similar. We went through the process just over a year ago, so we've been in it slightly longer, but one of the things I was nodding my head most vigorously to was agreeing with how flat the announcement fell when we first did it, because like Sam said, we went through this journey of learning and getting excited. And we actually sold 75% of the company. That's me and Andy, our business partner. And so we're 75% employee owned. And that felt like such a big deal. But again, one of the things that was, we had quite an open culture before as well. We shared the finances very openly. We tried to get as much input from the whole team. We're about to sort of, when we sold, we were about a 25-person company. So we got input from as many as we could do into the strategy and things like that. So there wasn't so much of a cultural shift. And that was in some ways one of the more difficult things to deal with, because we carried on in very much a similar way, and we had to try and work out what can we do that's different, that makes this feel a bit different, because it should be feeling different to people. People should be making decisions thinking, okay, this business decision that I'm making now, this win that I'm making is for everyone's benefit. It's not just for Rich and Andy's benefit to, get some more profit out of the company. And we haven't particularly nailed that, but I think it's, talking with other EO companies, it's just one of those things that takes time. And I think once people start seeing some of the benefits, I mean, even if it's something as tangible as those tax-free bonuses when they come through and that sort of thing, people start to twig when it comes to that. But also realizing that they can really quiz and probe the management of the company, because we are working for them now, not working for ourselves. And that's one of the big shifts that people can, they're well within their rights to start questioning decisions that we're making, because we're making those decisions for them as employees.
Cool.
Alex,
Okay.
do I jump in? Just a very small technical thing.
Please.
We sold 90% of our business to the Employee Ownership Trust, who then took and launched the EMI.
Ah.
But that's wrapped up within that vehicle. It's a small thing. But.
Well, no, I think it's very important. That's really interesting. Thank you. So a couple of questions from Luke for you, Sam. I think so. How does it feel to you, given the effort that you put into founding RocketMill and all of the hard work that went into it? Does it feel like a good deal for you? And would you have considered it earlier, knowing what you know now?
The timing, the stars aligned for us. So if you look at, I think we got to a point where our earnings meant the valuation was really meaningful. We were at a stage where I perceive, and this is important, there are many reasons for doing this. One of which should be, I think whenever we look at M&A, there are four things we look at: culture, strategy, the opportunity for our staff and our clients, and so on. But within this particular deal, strategically, the biggest risk to our company was losing our senior management team. I honestly believe, like, we started our business in a credit crunch. We've seen off Brexit, and now we've had a global pandemic, and actually we're still growing and we're still performing well. And we, like every business, lose the odd client, win more, and push on. And for me, the biggest risk to us was losing staff. So strategically, that moment in time where the EBIT had got to a point where it was really meaningful to us and there was loads of distracting opportunities in the market, this was a great way of securing our staff, uniting the entire business, lending itself even more to this people first type of philosophy that we've always prided ourselves on, and getting some value from the company that we've created over that time. So it felt fair. The timing felt like the kind of stars aligned for us. It's probably the easiest way of putting it.
And Richard, is that the same for you?
Yeah, the timing for us was kind of interesting, because our sale was scheduled and went ahead in April last year, just as whole COVID was taking hold. And we had considered thinking, well, let's just put the brakes on this. But we were so close to it happening, and we thought, well, let's go through it anyway. It could be useful. And I honestly think it was. It enabled us to look at that year that we've just had might pan out to be, and take long-term decisions, because that's the thing about employee ownership. You're working on behalf not just of your current employees, but for future employees as well. So, and that's why one of the reasons the government's very keen on these things and does the tax breaks and so on, is because they see longevity happening there and people making long-term decisions, not quarterly decisions to please shareholders. And so one of the things that we looked at with this year ahead, and knowing that we were now working on behalf of the employees, was, okay, if we have a really bad year, what we want to prioritize, aside from staying afloat, is to keep the people that we have, because we have really good people. Like, same sort of thing that Sam was just saying, that it's hard to find really good people, and it's relatively difficult to keep hold of them in some ways, especially when you have a small company which doesn't have that much in the way of progression. You have to give people something to hold on to while they're there. So that was the sort of decision we made fundamentally, was like, we're prepared to lose money if we keep people and then take that on the chin. We didn't lose money in the end, and we kept all our people, but that was decisions that we were able to make sort of ahead of time. And because we had a different way of looking at the business.
Okay.
So the timing was sort of good in a way from that point of view.
Fantastic. I feel a bit like an auctioneer. Any more questions? Any more bids on this? We're 2 minutes over 4 minutes over our allotted time. I've been so energized by this conversation. I think it's fantastic what Sam and Richard have done. Anything else? Otherwise, we'll close this out. Anna, thank you for recording it. I think everyone in Wired Sussex who runs a business should probably watch this this recording and learn from it. At least have that thought in their mind. So I'll wish you all a good day, I think, if that's...
Yeah, that's a great place to wrap up. Thanks so much for all your questions, and a big thank you to Alex and Sam for joining us today. Another thank you to Plus Accounting for sponsoring these sessions.
Thank you.
Next week we'll have Mark. I think you're on the call, Mark. You're from Plus Accounting, and you're talking to us about finance for freelancers next week. And then after that we'll have Beck from Create.net talking all about sustainability for your digital business. Check out the events page on our website if you'd like to join us for those. I'll post a link in the chat. And thanks for joining.
Bye, everybody. Thank you so much.